US Freedom Capital present opportunities in US and Indian real estate. Our esteemed panelists are market leaders from the private equity and real estate industry, discussing trends in Indian and US real estate investments, opportunities, and challenges ahead for the investors seeking global investments.
So our company is US Freedom Capital, and we created a fund, the US Freedom Capital Fund, specifically for global investors, global HNIs, to invest in US real estate. There are a whole bunch of reasons why direct investment by an HNI in their name in the US is a bad idea. I won't go through all of them, but I will tell you that the fund was specifically created to solve many of those problems. First of all is tax. And tax in the United States can be avoided by a global investor. And the structures that we have built compensate for tax. And for NRIs, non-resident Indians who are investing, or in non-Indian entities that are investing, this is a complete end-to-end tax-free situation. The major players in our market are listed REITs, pension funds, and the insurance companies. And so you see the hurricanes that are hitting the US, Houston, Florida, Puerto Rico. The insurance company funds that will be used to repay those come primarily from commercial real estate. It's a great place to store value. It's a great place to get a current return for the investment companies to pay their, insurance companies to pay their investors. And when the time comes to pay claims, it's a great store of value. US real estate is valued on the cash flow that it produces, not because it's better, but it's because it's more valuable. Cash flow is worth more than the actual building itself. Because you're focused on cash flow, now you're focused on yield, right? You have a current yield, and that's the focus of your analysis. And because of the low interest rates that we have, we can borrow money from the bank, use cheap bank money, which comes on very open, transparent, specific terms, and then we can gain a higher yield on equity that we're investing. Again, just to highlight the differences between the two, this is not good or bad. This is just, as Indians investing in Indian real estate, you've made logical decisions based on the environment that you're in. Americans investing in American real estate have made logical decisions there. So the ability to buy low and sell high is as much an emotional decision as it is an investment decision. So what does that mean in terms of numbers in the United States? If you were to look at the rental yields that come out, and this is taking every commercial real estate building in the United States and comparing it. This is every asset class combined together. Hotels, office buildings, residential, large-scale residential, industrial, retail. It's taking the entire geography of the US, the good performing parts, the less good performing parts, putting them all together, and you can see over time, and I'm down here at the bottom, the net income, which is the rent version, is paying a 4 handle on returns, where appreciation is only paying 3.5. And this is a building we'll complete this month in Dallas. It's a healthcare facility. The completion value is $24 million. It's worth no more the day after we finish it as a building, as an empty building, than it is the day before we finished it. It's worth $24 million. That's what we spent to build it. But as soon as the rent starts from the tenant, the capitalized income that a listed REIT is paying us for this building is $32 million. They're not buying the building to own a building. They're buying a building because of the 25-year lease that the tenant is willing to pay rent on. But if you come here and you have a long-term rupee depreciation, there might be some currency benefit. We're free of US income and estate taxes. So just as general guidance, if you take anything away from this, owning real estate in your own name in the United States is one of the most expensive things that you could probably ever do. So how do you get 50% of the value out of real estate? You have to sell it at whatever price you can get, because the tax authority is not going to wait for their money. Historical yields by asset class. So we spoke on this a little bit earlier, and I've broken this up into two basic categories. Discretionary spending, which is shown in red, and those would be things like retail, hotels, hospitality, and office space. You can always choose to expand your office space. You can choose to renew your lease. That's somewhat discretionary, but hospitality is truly discretionary in the US. It's primarily business travel. And retail, obviously, is tied to the emotional, it's called the wealth effect in the US, is how wealthy people feel is how much they're willing to spend on discretionary items. And so what does that mean for our investments? Just to give you an idea of what you should expect or what you should look for in the US. Our first strategy is called the current asset strategy. This is the most risk-averse investment that we offer. If you are interested in immigration, US green cards. You've probably heard of the EB5 investor visa. And one of the unfortunate things about EB5 coming to India is that it's coming with a Chinese model. And I can tell you that, because I've been there and I've seen it for myself, Chinese investors are not true risk analysts. They will sign documents put in front of them by a commissioned agent that they don't get to see all the documents. They never talk to the developer. They never visit the project. They never even talk to us. We've had Chinese investors wire money to us, and we didn't even know their name, and we didn't know the money was coming. That is a level of risk that I can't comprehend. And now when EB5 comes to India, it's coming with those same promoters offering 0.5% returns. So those are the two investment programs that we have. And again, the underlying real estate is all the same. So I want to just close with a brief description of risk in the US real estate and risk in Indian real estate. A couple of things that are different. Completion risk. When a US real estate developer who has a bank loan starts construction, all of the capital is in place. And the sponsor capital gets spent before the bank's loan. So that the capital stacks that we were looking at, the red gets spent before the green ever starts. The bank will ensure that all the money is in place to finish the project before the project ever begins construction. Number two, all of the permits are in place, and they don't change. And not only do the investors demand that they're in place, the bank demands they're in place. Third significant risk mitigator, I should say, is title. Title in the US is not disputed. And the way that you can prove that for yourself is that every piece of property that is bought or sold comes with title insurance. So again, we look at risk as something to be avoided at all cost, even if we have to give up return in order to get it. And if you were to ask Warren Buffett, how do you maximize return over time? Never lose money. Never lose money. And that's our goal. So thank you for having us. I've enjoyed our time here.
US Freedom Capital, helping you make wiser investment choices.